It's Monday, 20th of July, 2026. Welcome back to your news update on Blip, brief, crisp, but almost everything updated every market trading day. So imagine you are building this massive, gleaming skyscraper, right? But you're only pouring high-grade concrete for the top floors while the foundation underneath slowly begins to crumble.
Oh, that's a dangerous game.
Right, and that is exactly what the Indian equity markets look like this morning. Let's just unpack the previous trading day's closing movements. On paper, everything looks like a spectacular rally. The BSE Sensex closed up by 1.25%, and the Nifty 50 closed up by 1.09%.
Yeah, solid numbers on the surface.
And in the commodity space, gold moved up by 0.35%, while silver saw just a marginal tip of 0.06%.
Exactly. And, when you just glance at the headlines, the equity markets look incredibly robust. We are seeing mid-cap and small-cap indices hitting these unprecedented record highs. But the structural risk, well, it lies in that foundation you just mentioned.
Right, because when you actually look under the hood, the broader market breadth is lagging significantly. We are seeing these highly concentrated fund flows, and the major foreign institutional investors, the FIIs, are actively exiting blue-chip stocks.
Yeah, they are pulling out of the heavyweights.
So if the broader market breadth is weak and foreign capital's fleeing those heavyweights, isn't this entire mid-cap rally just a top-heavy illusion? What happens if that narrow foundation cracks?
It creates a really incredibly fragile environment. What is happening here is a severe divergence, right? A divergence between index performance and underlying market participation. When mid and small caps surge while large cap blue chips face aggressive foreign selling, it tells us something specific.
That domestic money is just chasing momentum.
Precisely. Domestic liquidity is chasing rapid growth and momentum rather than fundamental stability. Foreign investors are currently recalibrating their global portfolios, moving capital out of established Indian heavyweights. And this is likely due to shifting global risk appetites or just concerns over stretched valuations.
And in the meantime, you have domestic capital crowding into an increasingly narrow band of mid-sized companies.
Exactly. So while your skyscraper is reaching new heights, the base is narrowing by the day. This leaves the market highly vulnerable to sharp, sudden corrections. If that concentrated domestic liquidity suddenly dries up.
Or retail sentiment shifts.
Right. If that happens, there is no solid institutional buying at the bottom to catch the fall.
So let's actually test that domestic optimism against the hard numbers. We have an early sample of over 160 companies reporting their Q1 earnings, and the aggregate figures look incredibly strong. Revenues are up by 17.5% year-on-year.
Which is a solid top-line indicator, sure.
Yeah.
But what matters more is how much of that revenue actually makes it to the bank.
Well, the bottom line follows suit. Net profits for this sample are up by 14.5% year-on-year.
Wow, okay. Those aggregate figures demonstrate what we call operational leverage. In simple terms, companies are managing to translate top-line revenue growth into bottom-line profitability without their fixed costs eating up the difference. It shows that corporate India, well, at least in this early sample, has been absorbing operational costs quite effectively over the last quarter.
Let's look at the specific sectors driving those numbers, though. ICICI Bank posted a massive 16% year-on-year net profit increase.
That's huge.
It is. And then you have Reliance Industries, where we saw a very distinct internal divergence. Their energy division completely offset the weakness in their retail operations. But the detail that stood out the most is that their fast-moving consumer goods business, their FMCG arm, has finally turned EBITDA positive.
That is a major shift.
Yeah. But before we celebrate that, let's ground it for a second. What does being EBITDA positive actually mean for a conglomerate's daily operations?
Okay, think of it like running a very complex lemonade stand. EBITDA stands for earnings before interest, taxes, depreciation, and amortization.
Right, the standard accounting metric.
Exactly. So being EBITDA positive means that if you just look at the core business selling the lemonade, you are finally bringing in more cash than you are spending on lemons, sugar, and cups. It ignores the bank loan you took out to build the stand or the accounting depreciation of the juicer itself.
Got it.
Achieving this in FMCG is a major milestone because it is a notoriously capital-intensive sector. You spend years burning cash on marketing, building distribution networks, and dealing with razor-thin margins just to build brand loyalty.
Right.
So turning EBITDA positive signals that their aggressive pricing strategies and supply chains have finally reached economies of scale. The core engine is now generating cash.
That explains the long-term plays.
Yeah.
But we also saw massive single-stock percentage movers that just reflect the highly reactive, almost volatile nature of the market right now. Relaxo footwear soared nearly 20% in a single session.
That's incredible.
Responsive industries jumped over 16%. But then on the flip side, Grindwell Norton plunged over 14%.
Yeah, these aggressive double-digit percentage swings are the absolute hallmark of a market where valuations are already stretched to their absolute limits. In a normal environment, a slight earnings beat might bump a stock by a small percentage.
Well, a modest reaction.
But today, when a company like Relaxo beats expectations, algorithmic trading programs and retail capital aggressively pile in simultaneously, and that causes that massive 20% spike.
And I assume the reverse is true for the losers.
Oh, unforgivingly true. Grindwell Norton is a prime example. The market is pricing in absolute perfection right now. Any slight miss in margins or even just cautious forward guidance for management triggers immediate and ruthless sell-offs. The algorithmic safety nets just disappear and the stock plunges 14%.
It's brutal. Let's pivot slightly to a major headwind emerging in the banking sector, specifically regarding capital mobilization. HDFC Bank's specialized non-resident deposit program, their FCNRB inflows, are expected to completely miss initial estimates.
That's a significant development.
It is. And for the listener, an FCNRB is a foreign currency non-resident bank account. It basically allows expatriates to park their foreign earnings in Indian banks without worrying about exchange rate fluctuations. So why is this program suddenly failing to attract capital?
Well, it comes down to friction in cross-border capital flows. This program relies heavily on the expat community, particularly in the Gulf. However, the taxation framework for non-resident Indians has become increasingly complex to navigate.
Okay.
But more importantly, you really have to look at the macroeconomic environment where those expats are living. Tighter monetary conditions and severe geopolitical tensions in West Asia mean that expatriates are holding on to their liquidity. They are keeping their cash close at hand rather than remitting it to Indian deposits.
Which forces Indian banks to rely more heavily on domestic deposits to fund their lending.
Exactly.
And they have to offer higher interest rates to attract those domestic deposits, which increases their overall cost of funds.
Precisely. It squeezes the bank's margins from the bottom up.
And that seamlessly connects the banking squeeze to the biggest upcoming threat for those strong corporate earnings we just discussed, creeping input costs and inflation. Let's look at the macroeconomic data. Retail inflation has officially breached the Reserve Bank of India's midpoint target.
Not ideal.
No. And meanwhile, wholesale inflation is relentlessly nearing double-digit percentage growth. The primary culprits driving this are food and fuel costs.
And that gap between retail and wholesale inflation is the critical metric to watch here. Wholesale inflation nearing double-digit percentage growth is an alarming leading indicator. It means manufacturers are facing surging costs at the factory gate for raw materials, power, and logistics.
Right. And Deloitte is projecting India's economic growth to hit between 6.5% and 6.8% for the fiscal year. Their models expect festive demand and monetary easing to stabilize things in the second half of the year.
That's an optimistic take.
Yeah, because the RBI governor has directly flagged weak monsoons and West Asia tensions as the most severe risks to the Indian economy right now. Are we just looking at a seasonal monsoon hiccup here, or is this a systemic pricing crisis that will permanently dent manufacturing margins for the rest of the year?
Honestly, it leans much more heavily toward a systemic pricing crisis. Manufacturers can only absorb those double-digit wholesale increases for so long to maintain their market share. Eventually, that pressure bleeds over, and they have to pass the costs on to the consumer.
Which obviously drives up retail inflation.
Exactly. The monsoon hiccup primarily affects food prices, which are notoriously volatile and often seasonal anyway. But fuel and logistical costs, those are foundational. They dictate the price of transporting every single good in the entire economy.
So when Deloitte models out a 6.5% to 6.8% growth rate based on the assumption of monetary easing, are they underestimating the margin compression?
I think they might be. Margin compression happens when a company's costs go up, but they can't raise their prices fast enough to match, so their profits just get squeezed. Deloitte's projection relies on the assumption that the RBI will actually have the macroeconomic space to cut interest rates.
Which they might not have.
Right. If inflation consistently breaches the upper tolerance bands due to these uncontrollable supply-side shocks, the RBI absolutely cannot cut rates. They may even be forced to tighten liquidity further just to cool demand. If manufacturers are paying double-digit percentage increases for inputs and their borrowing costs remain high because the RBI holds rates steady, corporate earnings in the second half of the year will face severe margin compression.
Wow. Okay. And this brings us directly to that external variable the RBI governor explicitly warned about, the escalating crisis in the Gulf. We are looking at a profound geopolitical shockwave. Now, based purely on the sources, the U.S.-Iran conflict has escalated into direct military exchanges.
Yeah, it's a rapidly developing situation.
It is. The U.S. launched airstrikes following the deaths of 2 American troops in Jordan. In retaliation, Iran has targeted U.S. bases in Kuwait and launched region-wide attacks. And I just want to state clearly that we are impartially reporting the events as detailed in the source material without endorsing any viewpoint here.
Of course.
But the immediate economic consequence for the markets is that a ship has caught fire in the Strait of Hormuz, causing shipping traffic in this critical global choke point to largely stall. In response to this blockade threat, crude oil prices have surged by a significant percentage.
The Strait of Hormuz is arguably the most vital geopolitical vascular system for the global economy. I mean, a massive percentage of the world's daily maritime oil consumption passes through that narrow waterway. It is a fundamental choke point.
Absolutely.
When shipping stalls there, even temporarily due to a fire, the insurance premiums for tankers skyrocket, and the risk premium on global energy instantly inflates. That completely explains the significant percentage spike in crude oil you just mentioned.
And for an energy-importing nation like India, this isn't just news, it is an immediate macroeconomic shock.
Absolutely. It artificially inflates the national import bill, puts downward pressure on the currency, and literally imports inflation directly into the domestic economy by raising the baseline cost of fuel.
India's strategic response to this is currently unfolding, actually. The government and oil marketing companies are actively exploring the use of UAE ports, specifically Fujairah, to bypass the Strait of Hormuz entirely and secure its energy cargoes.
Of a very strategic move.
But looking at a map, bypassing Hormuz through the UAE feels like rerouting the body's main artery during open-heart surgery. Can this alternative logistical route genuinely handle the massive volume of India's daily crude demands?
Well, it is a brilliantly executed contingency plan, but it has severe volumetric limitations. The port of Fujairah sits on the eastern seaboard of the UAE, facing the Gulf of Oman. This means ships can dock there without ever entering the Persian Gulf or crossing the Strait of Hormuz.
Oh, I see.
Yeah, oil is pumped overland from Abu Dhabi's massive oil fields directly to Fujairah via the Habshan-Fujairah pipeline. So yes, you can technically load crude onto tankers safely outside the conflict zone.
But I'm guessing a pipeline can only move a fraction of what a massive fleet of supertankers can.
Exactly. That pipeline has a maximum throughput capacity. It simply cannot entirely replace the sheer volume of maritime traffic that typically flows through the strait. Furthermore, it only secures UAE crude. If India needs its contracted crude from other Gulf nations like Iraq or Saudi Arabia, those shipments are still physically trapped behind the blockade.
Right.
So it is a necessary alternative artery, and it provides a critical buffer, but it cannot handle the full systemic load of an economy growing at over 6%.
The logistics of global energy are just incredibly fragile. And it's fascinating how global events are completely reshaping supply chains. Because while we see these massive supply chain blockades in the Gulf, we simultaneously witnessed an unprecedented consumer supply chain surge right here at home.
Driven by the football match, right?
Entirely driven by the FIFA World Cup final. Spain defeated Argentina 1-0 in extra time to win the World Cup, a grueling match that left Lionel Messi in tears.
It was an intense game.
But the real story for the domestic economy is the immense business impact across India. Quick commerce and food delivery apps experienced an absolute ordering frenzy leading up to and during the match. Direct-to-consumer brands, snack foods, and football sportswear completely shattered previous sales records.
Oh, absolutely.
And pubs and restaurants saw pre-booking volumes they haven't seen in years. We see this moment marketing every time there is a major tournament, but I have to ask, is this just a temporary sugar rush for quick commerce platforms, or does it actually drive a permanent percentage increase in customer attention?
Historically, you would be totally right to call it a sugar rush, a spike in pizza and beverage orders for one night, and then the next morning server traffic just returns to the baseline. But the fundamental architecture of quick commerce has changed the equation here.
How so?
Well, these platforms are no longer just in the business of fulfilling an isolated order. They are in the business of behavioral engineering and establishing logistical reliance.
Because ordering a jersey 10 minutes before kickoff feels like peak impulsive behavior, not exactly a long-term habit.
It is impulsive, but the platform uses that impulse as a Trojan horse. When a consumer uses a 10-minute delivery app to order that jersey and snacks right before the match, they are experiencing extreme convenience during a high-emotion, high-urgency event.
Right. They are stressed about the match starting.
Exactly. The platforms leverage the specific cultural moment to drive app downloads and first-time usage among demographics that might otherwise be entirely hesitant to try quick commerce. Essentially, it functions as a massive, entirely self-funded customer acquisition campaign.
So they use the stress of the match to overcome the friction of downloading the app in the first place.
Precisely. And the permanent percentage increase in customer retention comes from the habit-forming nature of the service. Once a consumer trusts the platform to deliver flawlessly during a high-stakes moment like a World Cup final gathering with friends, the psychological barrier is broken. Statistically, they are far more likely to open that exact same app for routine, boring grocery shopping the following Tuesday.
That makes a lot of sense. And it isn't just the delivery platforms benefiting. The individual brands are harvesting an incredible amount of intelligence from this.
Yes, absolutely. The direct-to-consumer brands partnering with these platforms gather granular, real-time data on micro-market preferences. They know exactly which neighborhoods ordered which specific snacks at what exact minute of the match.
Wow.
Yeah, that allows them to optimize their inventory positioning in local dark stores for future demand, which fundamentally lowers their long-term supply chain costs.
This heavy reliance on digital platforms, hyperfast quick commerce algorithms, and real-time logistics tracking connects directly to our final segment today. The modern digital economy, whether you are executing algorithmic trades in Mumbai or ordering groceries in Delhi, requires incredibly advanced space infrastructure to keep running globally without interruption.
It's the invisible backbone of everything we do.
It really is. So let's talk about the latest major technological innovation in the orbital push. SpaceX is targeting July 23 for its 13th Starship test flight. After a last-minute abort previously, this mission will carry 20 Starlink satellites on a suborbital test.
Okay, suborbital test.
Right. The goal here is that this specific test will act as a critical technological stepping stone to allow the company to achieve routine, massive-scale orbital deployments by the end of the year. If successful, this fundamentally alters global satellite internet infrastructure. But here is what I don't understand. If the ultimate goal of Starship is deep space exploration and routine orbital deployment, why are they intentionally focusing on a suborbital test? Is this about testing the release mechanism of the satellites or the structural integrity of the ship itself?
It is entirely about isolating very specific, highly volatile engineering variables, primarily the payload deployment mechanism under extreme aerodynamic stress.
Yeah.
I mean, when you're deploying 20 massive Starlink satellites, the release mechanism must operate absolutely flawlessly.
I've seen the schematics. People compare it to a giant Pez dispenser. Do they literally just pop out of a slot in the side of the ship?
That is actually a very accurate analogy. They are stacked and dispensed through a narrow payload door, but they have to do this in a microgravity environment while the vehicle is moving at immense speeds. Doing this suborbitally allows SpaceX to test the structural integrity of those payload doors and the dispensing physics without committing the entire vehicle to the thermal extremes and higher velocities of a full orbital reentry.
Because if it fails in orbit, the consequences are disastrous.
Exactly. If the release mechanism jams while in full orbit, you don't just fail the mission, you potentially create a massive, uncontrollable cloud of space debris traveling at orbital velocity. And you likely lose the vehicle entirely.
Which sets the program back years.
Without a doubt. By testing suborbitally, they validate the most complex mechanical operation of the mission profile. If it fails, gravity pulls the debris down safely. If it succeeds, they maintain a much higher probability of recovering the ship intact to analyze the telemetry data.
So if we look at the big picture, what does this actually mean for the listener? I mean, if SpaceX masters this Pez dispenser deployment and achieves routine massive-scale deployment by the end of the year, it exponentially increases the bandwidth and lowers the latency of global satellite internet. That means the entire digital economy becomes decentralized.
It raises a vital question about the immediate commercialization of low Earth orbit. We are transitioning away from space being this boutique, government-funded research domain. It is rapidly becoming critical commercial real estate. When launch costs drop significantly in percentage terms due to massive, fully reusable vehicles like Starship, the underlying economics of space change literally overnight.
Which leaves you with a profound thought to mull over as you start your trading day. If the cost per kilogram to reach orbit continues to plummet at this aggressive percentage rate, how long before we see terrestrial businesses moving their most energy-intensive operations completely off-planet? We might soon be looking at a reality where highly polluting space-based manufacturing or even massive orbital data centers that are naturally cooled by the freezing vacuum of space becomes standard operating procedure for the sharp professionals listening right now.
And just before you go, a quick note, this deep dive commentary was put together using advanced AI. We always strive for accuracy, but please do cross-verify any crucial information yourself. Your informed decisions are what matter most. The content shared here is for informational and educational purposes only and should not be treated as investment or trading advice. Past performance is not indicative of future returns. We are not licensed financial advisors.